Imagine starting completely from scratch in 2026. No money, no investments, nothing. But you still carry every lesson you've ever learned about building wealth. That kind of knowledge would be a serious advantage because the biggest mistake most people make early on isn't choosing the wrong stock, it's overcomplicating the entire process. Investing doesn't need to be complex, it just needs to be consistent. Picture this, it's the beginning of the year and you've managed to set aside $1,200. Inflation in the US averaged around 2.7% in 2025 and is projected to hover around 3% in 2026. That means if you're spending $3,400 a month, your expenses could rise to roughly $3,500 by 2027. If you stash that $1,200 in cash, it's still just $1,200 by December, while everything around it gets more expensive. In real purchasing power terms, you've lost money without spending a single cent. A high-yield savings account is a better option, offering between 3% and 5% annual interest, turning your $1,200 into roughly $1,254 after 1 year. That keeps you ahead of inflation, but it won't build wealth, it just protects what you already have. Here's the difference. When you save, the bank pays you interest because it lends your money to others. When you invest, you become a partial owner of a business that's working to grow, and you earn returns when that business succeeds. One share of Apple purchased in 2010 for around $10 would be worth over $200 today, not counting dividends. That's a 20 times increase that no savings account has ever delivered. The stock market has historically returned about 7% to 10% annually over the long term, even after accounting for crashes and corrections. But investing only works when the companies you choose actually perform well. Not every company follows Apple's path. Palm, a smartphone brand from the same era, had $460 million invested into it by prominent backers, including Bono from U2. By 2010, the company was acquired by HP for approximately $1.2 billion, a fraction of what early investors had hoped for. And within a few years, the brand disappeared entirely. Concentrating all your capital into a single company exposes you to exactly this kind of risk. That's where ETFs come in. An ETF is built by an investment company, like Vanguard or Schwab, and holds shares across many different companies within a single fund. SPYM, formerly known as SPLG, tracks the S&P 500, which is made up of the 500 largest publicly traded companies in the US, including Apple, Microsoft, and Amazon. It reduces your risk because your returns aren't dependent on any single company, and it saves time because you don't need to constantly monitor individual stocks. SPYM and QQQM are strong starting options, the latter focused on innovative technology companies listed on the NASDAQ 100. Before investing, though, two things need to be in place. The first is clearing high-interest debt. If you owe $5,000 on a credit card at 23% interest, you're paying around $95 every month just in fees. That doesn't stop until the balance is fully cleared. Any extra money is better applied toward eliminating that debt first. The second is building an emergency fund, generally 3 to 6 months of living expenses in a high-yield savings account. When you invest, the goal is to leave that money untouched for at least 5 to 10 years. You don't want a broken laptop or an unexpected medical bill forcing you to liquidate investments early. Once both are handled, you're ready, and you don't need much to begin. Many platforms let you start with as little as $1. Investing $1 a month for 40 years at a 10% average annual return results in approximately $5,300. Raise that to $10 a month, and it grows to around $500,000. At $1,000 a month, that's roughly $5.3 million over the same period. Start with what you have and increase contributions as your income grows. 3 strategies to carry forward from here. First, automate your investing. Set a recurring contribution so it happens every month without relying on willpower. Think of it as paying your future self a salary. Second, don't sell when the market dips. During the 2020 pandemic, markets dropped sharply, but those who stayed invested watched them recover and reach new all-time highs within a couple of years. Most well-established ETFs trend upward over time because when one company struggles, others compensate. Third, stop trying to time the market. Research has shown that even investors who bought at the worst possible times still achieve strong long-term results through consistency. Nobody can predict the market. The only variable you control is how consistently you keep investing, regardless of what the headlines say. The investors who build real wealth aren't the ones who started with the most money. They're the ones who started early, stayed consistent, and kept the process simple.